And REITs have different strategies as well. Like, for example, and I'll just use some of these right now. Like one of the listed REITs is National Storage.
Yep.
So, I mean, the name kind of says it, doesn't it?
They're McDonald's chains, right? Like,
yeah, they do fast food.
Yeah, so they do like storages under the brand of National Storage.
Completely. So they have land they own. There are businesses that operate on that land, which are storage facilities, and they keep building that out and doing more of it. They expand, and they, just like there's renters of houses, there's people that rent the storage units. And that's how it all works.
Is it true that there are more commercial REITs than residential REITs?
I don't think there's any residential REITs.
So it is just all commercial.
Well, actually, I should take that back. That's a listed sense.
Listed,
like I've looked, and that may have changed in the moment right here, but the thing I would look at is like a REIT tends to have a strategy. So whether it's listed or unlisted, they tend to have something they do. And like if you were to go on Google right now and just search for the list of Australian REITs, you get a whole bunch of them. And there's some really unique ones out there. So National Storage, as I said, like they do storage. There's industrial REITs. There's Mirvac. There's Stocklands that do, big greenfield estates. I believe, I can't remember the name of it, but there's like a REIT out there that just does the land that Bunnings operates on. They do that type of property.
The Bunnings land REIT.
Yeah, well, if I reshaped this conversation quickly and I'm like, dude, there's different businesses that are listed on the ASX. There's companies that are banks. There's companies that are mining, right? You're like, of course there is. Like, what are you trying to say here? I'm like, well, REITs are kind of the same. There's hotels, there's offices, there's some that do developments, there's a whole bunch of things.
There's heaps, yeah.
Correct. So not all REITs are created the same or equal, and the returns they get can also be very, very different. One of the things that's kind of cool, though, and I hinted at this before, is that I believe it's VAP is the ticker, or MVA is the ticker, which it's like there's ETF REITs. So this is you can buy a share in a group of REITs, which is like a bunch of them put together I think the idea would be to diversify there.
If you just can't choose, you just go with them all.
Yeah, well, maybe you want a little bit of exposure to the industrials, a little bit to offices, a little bit to developing, right? There's reasons and things that would have that come into play. And I'll just paint a scenario here. Let's say you've been a property investor for, from your 20s to your 70s, and you just like cannot be bothered with managing properties anymore. All right, you're just at this place where you're like, I'm just done with this. The manager's ringing me. To potentially like sell down a portfolio and put it into REITs because you want to be exposed to real estate in some way kind of makes sense to me. You get to be very passive in nature. You don't have the management responsibility. Like there's for some people, just like people who are overseas who can't access finance, right? It serves a very real purpose. There's also this kind of layer that goes with REITs is like maybe you love the idea of going, do you know what? I love the idea of having Bunnings as my tenant, right? Or investing in hotels, but you just don't have the capability to do that on your own, is you can get in with a group of people that are doing that and get exposure to that particular type of real estate if it's something that, tickles your fancy.
Yeah, you can kind of ride your own personal megatrends or trends that you think are happening and get it and remove yourself from exposure, which is actually a really good segue into like one of the questions I had around liquidity because, well, it's property investing, Charley, is the podcast. So most people listening to this are either have their own investment properties or looking to get their own investment properties. And we get to choose what we do on these properties. We get to choose if we would like to sell them. And the probability is that all of us understand that it's going to take us quite a few months to sell a property if we go, today I want to sell something. It's not like I can click my fingers and it's gone by the end of the day. For REITs, and I would love you to separate it between like the listed REITs versus the unlisted REITs, what's the liquidity time frame? Like, are these things really quick to sell, which is where the appeal from it is of going, I can get into real estate, I can get in, I can get out really quickly. Is there some kind of layer that we need to understand from it, or is it just trade like a normal share?
So for the listed REITs, I'll start with, they trade on the ASX in this case here, where it's like you can go on and essentially like pretty much any day sell them as long as the markets are open or buy them. Right. Now, of course, there has to be enough volume to support that, but in general, they're very liquid. So, and I use that as a comparison, right? Because they're very liquid in comparison to, let's say, you own a property and you're going to go sell that with a real estate agent. That might take months. You might have to prepare the property for sale before you can even list it for sale, and then selling it might take several months. And then you've got settlement, which is potentially like 60 days after that. Like it's a long process to sell a property that you own directly. Right? So you've got highly liquid, which is the listed ones. For that reason alone, that might be one of the reasons you go that path if you value liquidity.
Yeah.
The second category I mentioned, which is the unlisted ones, and this is where it gets a little bit hairy. In a lot of cases, this could be more liquid or less liquid than a property you own directly. And I just want to explain a scenario. Let's say you invest in a REIT that's, we'll make it this one, it's National Storage, right? And I want you to pretend that, everyone's put in $1 million. It's 10 people and they've all put $1 million and they've bought one building that's $10 million. Let's say one person wants out. Where are they going to get the money?
What,
right?
They're not going to sell the entire property down for this one person to get out.
Completely, they don't. And they can't because they'd have to like potentially take a loss in the circumstance, or there's other layers to this where it's like, if you dig more deeply into this, it's like, well, you actually have to sell your share of the REIT. So there has to be another buyer come across, or there has to be someone within the organization where they can create that type of liquidity. Now, in some of the bigger unlisted REITs, they actually keep some liquidity to move people in and out of at times. And I know I'm because there's a lot of strict rules around this where I'm like, I don't want to necessarily say, oh, Charley said this on a podcast, everyone can get in and out. But at times there's some that they might have a wait list of people that want to buy into a REIT, and there's got to wait for someone who actually wants to sell a section of an unlisted REIT. Right? It happens. They're not always open, and always like there's closed funds and open funds as well, and things to take into consideration, which we may dance into next. But the whole point is that in the case where you're in a small REIT and it's an unlisted one and you wanting your money back and they can't sell the asset, you can end up stuck. It happens.
All right, fellow property investor. If you loved the value from this short video and wanted to know more about how you can win at property investing, check out the full episode by clicking the link on your screen or in the description right now. Alternatively, click subscribe and you'll never miss another one of these videos.